Today is a very interesting topic called measurement, valuation, and disclosure. And we will take the long-term assets today, which is like your assets more than 1 year, like your non-current assets. With this, we will also discuss the investment in equity method, investment in debt and securities, property, plant, and equipment, which is your tangible assets. And we have some asset which we cannot touch, but they are very precious. So these are intangible assets. So as we already know as an accountant that we have assets, we have liability, we have equity. Equity is your money in the company from which we have started, and it has different sections which we have already discussed in the first chapter. So let's talk about the classification of these securities. What is security? Security is a big word. Wherever security is written, it means a lot of things included in security. For example, your share, preference share, ordinary share, any kind of financial instrument will be taken as a security. So we buy securities, we sell securities in the business with three reasons. One is we want to make quick money, so we do a trading. So trading is we are buying today, selling after 1 hour, 2 hour, 1 day, or maybe 2 days, 1 week. But when we bought it, we have a specific reason that we will sell them. So once we will sell them, they will become a trading instrument. Sometimes we buy something and we have an idea to keep it for some period of time. That is called held to maturity. For example, you bought a piece of land, and when you bought, you thought that you will keep it with you for a period of time. So that's how the held to maturity can be taken. And available for sale means that we have decided to sell this. Previously, it was held to maturity for say 2 years. After 2 years, we want to sell it. So when we want to sell it, we make it in an account called available for sale. So that's how these three type of securities can be classified. These are very important information which has been used in your practical life or in exams also. So keep always in your mind, there are three types of securities. Now, you need to understand that the company's wealth is growing, and previously they used to work in one company, but now they are making a group of companies. For example, a small company nowadays have company A, company B, company C. So it's actually create a concept of a group accounting or a group financial reporting. In terms of your group financial reporting, the most important concept is a significant influence. Means that how much you can impact the decision making of a company. For example, I'll make one example. You are a group. You have three companies, one 100% yours, one is 40% yours, and one is 15% yours. Now, 15%, we can see that there is no control. So we say that less than 20% is you don't have any control and it is someone else's entity. You just have a share of 15% in this. 40%, we can say that you have a shareholding in a company, and if you have control on the management, so it will be taken as your subsidiary, and you will consolidate it in your main group. So we may have investment smaller, bigger, higher. So based on how much the investment and what is the Management influence means, do we have a management power in these companies? If we have management power in these companies, then means that these are in our companies, and we have to consolidate them as in a normal way. So these are the ones. Harry made a table for you, and it is very, very likely that if you memorize this, will be easy for you. So control greater than 50% ownership of voting stock. So if not applicable, so there is no debt investment security. But if you have 50% invest shares of a company, you need to consolidate, compile in your what you call the group financial statements. If it is between 20 to 50, then you can use an equity method. So what is an equity method? This method I will explain shortly. And if it is just held to maturity, then we have to use a cost method. So it's actually summarize your lot of concepts into this table, because question will be based at which one has to be costed on which one. So this is very important, and debt and equity should be on the fair value methods that we need to use. Now, I just made a format for you to understand that how the subsidiaries work. So you are a group of companies, you have different subsidiaries in different part of the world, like Nestle is working in Switzerland, in Dubai, in Saudi Arabia, say in other countries. So these are different branches they have. So, but how they decide it's a branch or it's a significant control or no. So these are the percentages given here, 20% non-interest or interest. So these are the practical way we chalk out all the list in a format to see that. So we can classify as an associate, subsidiary, or we can decide that which one we will consolidate and which one we will not do the consolidation. Okay, very important concept is the impairment test. What is impairment? So every year assets lose its value, which is called depreciation. Now, when we are talking about depreciation is a tool to reduce the value of an asset over the period of time. But sometimes, because of market condition, the market can crash. Market can go really down. So in that circumstances, what you need to do is very simple. You need to see extra decrease in value, which is called impairment. Impairment we don't see every year. It comes after, previously it used to come after 30 years. Now it's coming every 3 years, 4 years. You know, we have COVID. Before COVID, there was a recession, and 3-5 years before also there was a recession. So whenever there are market changes, there are impairments. So suppose in your books, there is an asset for $100 million, but actually if we want to sell it that time, we can only sell this asset in 70 million. So this 30 million that has been dropped is called impairment. So impairment is a loss, and how we calculate what is the written down value or carrying value, which is assets minus accumulated depreciation. And we compare with the market value, which we call it as a fair value. So it will give us a loss. So impairment losses happens, and when the assets, so we have to be very alert as a management. We have to look into impairment every year. We have to test it. Our assets are perfectly valued, or if they are not valued, how it will be corrected by using a concept of impairment.